On August 8th, less than a month ago, I did an article where I featured several stocks. One of them was FedEx. And this is what FedEx looked like on August 8th, 2022. You can see analysts were expecting estimates, earnings to average $20 a share, 20.61 in 22, $23 in 2023, and $25.67. This made the company look extremely cheap. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. And we obviously all are aware that the markets have been really tumultuous lately, and we saw a really significant drop in FedEx stock price today. It was down over 23% at one point. It's down to roughly $159 a share as I record this. And it was, it looks like a common disaster, but I love an opportunity to provide a teaching moment because I personally do not think that the long-term thesis and story for FedEx has changed. I think we're going through what Marty Whitman, the great manager of the Third Avenue Value Fund, would have called a temporary interruption in a great business. I think long-term FedEx is going to be fine. And what I really see happening here is that the company is now giving us an extremely attractive opportunity to invest for the long term. And I want to emphasize for the long term. So let's go back into the fast graphs here and let's look at what FedEx looks like now. Analysts have upgraded their estimates, and what was going to be $20 a share is now $15.95 expected for fiscal 2023, which ends, by the way, in May. In May of 22, they earned $20.61. This is adjusted operating earnings I'm looking at. They do expect earnings to recover to $20, but they were expecting a higher number than that going forward for 2024. And then they do expect $25 in 2025. The point I want to make, if I look at the current value of FedEx and go into the custom calculator, it's trading at roughly $159 a share. And if I go ahead and put the $15.95 in here, I'm only going to do one for you just for brevity's sake. If I put the $15.95 in there, you can see that the opportunity, even by a 15 PE by year end on these new earnings would give you a tremendous rate of return. So and they're looking at $20 a share in 2024, but I'm going to leave it because the computer automatically calculated it as $18, which is more conservative, and that would be a 39% upside. The company's yielding 2.89% right now, and so you can buy this stock at an extremely attractive valuation. I think the important thing that I want to make, and maybe I should have stayed on this calculator here, is that the risk, I believe, is already priced in. Value investing, in my humble opinion, known as, AKA Mr. Valuation, is the ideal way to invest when you're coming into recession. There's obviously going to be a lot of uncertainty if we do enter a full-blown recession coming up. There's going to be weakness in stocks like supply chain stocks here. We're seeing that, the supply chain is weak. People are cutting back. Revenues have dropped. But this is still a very profitable company. And even with the expectations of the quarter being much lower than originally expected, I don't want you to take the sight off the fact that we're still talking about a very profitable company that is, theoretically, by the May of 2023, going to be earning one of the highest profits the company's ever earned in its history, maybe the third or fourth best profit ever. So we're not talking about a company that's going bankrupt. And looking at some of the other important metrics, because this is a dividend-paying stock, cash flows are also expected to come down. By the way, you can visit that previous video I showed you, this video that I did, 5 dividend-paying bargains in the industrial sector, and you'll be able to look at some of these metrics, what they looked like a month ago. But we are expecting cash flows to drop, but they're still dramatically above what the company needs to pay their dividend. I think that's really important. Now, free cash flow has been problematic for this company in the last couple of years, but it is a lot stronger now and is expected to still be covering the dividends going forward. So all in all, I think what you're looking at here is an extremely attractive buying opportunity. Am I saying you should buy it today? It'd probably be wise to wait. When a company gets beat up like this, it's not going to recover all that quickly typically, but it could. But if you were to make a purchase today, I don't think you would go wrong if you were thinking long term. And I want to re-stress this. Value investing is ideally tailored for investing in treacherous times like recessions and bear markets. especially after the stock has already fallen. Now, if you're looking at stocks that are trading above their theoretical value, even if it's been adjusted downward like we've seen with FedEx, that's a different story than looking at a company that has now gotten extremely inexpensive based on what its long-term potential was. And I would suggest that you go into the company's website here and look at and read carefully their FedEx preliminary first quarter financial report, which was published yesterday, September 15th, which has got everybody in a furor and having the stock drop 23%. You know, the numbers that they're talking about are not Armageddon by any stretch of the imagination. And they also give you some insights into the outlook and some of the things that the company's doing there in terms of cost initiatives to basically get themselves back and returning back into profitability. Long term, I think this company is an excellent option. And if you go on their website as well, you can look at some of their, discussions where they talk about what the market's going to look like, how more people are shopping online, and how their company, is really preparing for that. And not to ignore the fact that the company still has maintained their commitment to buy back $1.5 billion in stock. And I think their dividend is still very much intact. So I did want to give you this quick update on what FedEx looks like now. And I want to point out that we're not looking at the orange line going down to zero. We're looking at the earnings of the company dropping ever so slightly. We're looking at the cash flows from the company dropping ever so slightly. And I think this is actually very, very important, what I'm about to say here next. When I look at revenues and sales, they're actually expected to grow, but at a mooted rate, maybe 3, 4, 5, 6%. But they are expected to grow. And then, the company has got all these initiatives. They closed 90 stores or 90 of their, operations down. They're doing things to cut costs and prepare themselves to be a leaner, meaner stock as we go through these economic hard times. So bottom line is, I think this is what we're getting here is a great opportunity to add. The dividend was, reasserted about a month ago. I expect it to continue to be reasserted, but that's something to watch for. If the company does cut their dividend, then that might be a change in, thinking of going forward. But right now, I think we're looking at an opportunity to buy this incredibly, high quality company, leader in its industry at a very, very low valuation with a dividend yield that's approaching 3% and a dividend growth record, which has been very excellent over time. If we look at long-term performance, forget about these numbers because we don't have them calculated, you can see that the company has been growing their dividend by 15 or 16%. They didn't grow it in 2020 and 2021. They are on pace to increase it by over 15% this year. And again, they reiterated the $1.15 just recently. So, we're looking at still, a possibility of seeing even, in excess of $3 a share coming up here for this next year. So the bottom line is, I think this is a great opportunity to buy this stock. I do think it's cheap right now. I do believe the risk is already baked in to the stock price, and especially after today. So I just wanted to, bring you back to reality. Look at this company long term. Don't think of it over the short run. Anyway, this has been Chuck Carnevale saying thanks for watching. I wanted to provide this update because this is and people are getting nervous now, and I understand why. But if you're positioning yourself as a long-time investor and investing for dividend income, these are the things that give you, opportunities that only come around ever so often. So I'm still very, very keen on FedEx. I think it has a great long-term future for a lot of reasons, and you can conduct some research on your own, and I think you'll see those reasons are validated. I appreciate your watching. This is really the power of FastGraphs. If you're not a subscriber to FastGraphs and you own common stocks, please take a look at it. It's a very powerful and very important tool to have, especially when you get into recessionary times like we could be facing in the very, very near future. Thanks for watching. Ring the bell, give me a like and do all those other nice things as well. Thanks for watching. Everyone have a great weekend.